Bond yields just flipped downward despite oil hitting new highs above $100, and Canadian variable rate mortgage holders have a narrow window to lock in rates before it's too late. Good evening, I'm Steve, and this is the Daily Brief Canadian Macro. Today we're covering some critical developments for Canadian investors and homeowners. Market Mania released new data showing nearly half of Canadians are living paycheck to paycheck and using payday loans just to buy groceries. Mark Mitchell issued a warning for variable rate mortgage holders about locking in rates before Middle East tensions drive borrowing costs higher. And Eurodollar University provides an alternate explanation of why bond markets are signaling recession despite surging oil prices. Let's start with what's happening to Canadian households right now. Market Mania covered what they're calling a Canadian economic depression, with nearly half of Canadians now living paycheck to paycheck and financing basic groceries through payday loans, credit cards, and lines of credit. They point to some striking numbers. Basic grocery shopping now costs $260 on average for two people weekly in areas like North Vancouver, with simple meals for two running $30 to $35, driving people to cut meals entirely. What's interesting here is that even mainstream media is now recommending these desperate financing strategies for those without emergency funds. The creator also highlighted that the job market is what they call cooked. People are applying to thousands of jobs with minimal responses, while mass layoffs of hundreds of people at single companies are becoming common. They noted that mortgage renewals are forcing people out of homes despite getting raises, with monthly payments becoming unaffordable even for those who haven't lost jobs. This connects directly to what Mark Mitchell is warning variable rate holders about. Mark Mitchell had a specific warning for Canadian variable rate mortgage holders. Lock in your rates now rather than waiting, because by the time it's obvious rates will rise, fixed mortgage options will already be more expensive. His key insight is that 5-year Government of Canada bond yields, which dictate fixed mortgage rates, are already up 60 basis points since the start of the Middle East conflict, even before rate hikes materialize. Mitchell emphasized a costly misconception many borrowers had in 2022. You can only lock in at the fixed rate available when you choose to lock in, and not the rate originally offered when you first got your variable mortgage. Mitchell pointed to the Pentagon preparing for a longer Middle East engagement with 10,000 additional troops potentially being deployed, which historically leads to extended conflicts that keep oil prices elevated. The bottom line, though, is most mortgage lenders will allow you to lock in your variable rate at no charge, but Mitchell warns if fixed rates of 5 to 6% would break your finances and threaten your ability to keep your home, you should lock in before reaching that point rather than gambling on geopolitical outcomes. But here's where things get interesting, because bond markets might be telling a different story altogether. Eurodollar University explained why bond yields are actually reversing downward despite surging oil prices. Markets believe central banks may have already missed their window for rate hikes as recession indicators emerge faster than inflation expectations. They highlighted what they called the most ominous signal. The 5-year forward rate dropped to 206 basis points near multi-year lows, showing bond markets see no long-term inflation risk despite oil shocks. Their data shows Treasury yields reversed sharply when U.S. markets opened Friday. The 10-year was down 15 basis points and the 2-year plunging over 20 basis points in 2 days, despite oil hitting new highs above $100. What's particularly relevant for Canadians is that the Bank of Canada is identified as among the central banks that Eurodollar University says are staying rational, looking past short-term oil CPI effects, while European and Japanese banks are in what they call inflation DEFCON 1 mode, preparing rate hikes. They also noted that Treasury inflation-protected securities, TIPS, break-even rates, peaked March 18th and have since fallen 10 to 15 basis points, with 5-year break-evens no longer following oil prices higher, showing inflation expectations are collapsing. Looking across today's analysis, we're seeing conflicting signals that Canadian investors and homeowners need to navigate carefully. Market Mania's data suggests the Canadian economy is already under severe stress, with households financing basic necessities through high-cost debt. Mark Mitchell argues that this makes it even more critical for variable rate holders to lock in now before geopolitical tensions drive rates higher. But Eurodollar University suggests bond markets are pricing in recession risk faster than inflation risk, with the Bank of Canada among those looking past short-term oil price effects. The tension here is timing. Mitchell warns that 5-year GOC bond yields are already up 60 basis points since the conflict began, while Eurodollar University points to U.S. Treasury yields reversing sharply downward as recession indicators emerge. The key argument: energy shocks are deflationary, not inflationary, as they destroy demand and profit margins, leading to layoffs. Well, that's your daily brief for today. All credit goes to the creators featured. Their original analysis and videos are linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.